Let's go into the second paper, which looks at the market from different angle. They look at the losses in the security portfolio and how they actually might affect banks' ability to lend in the market. So Dominik, please, you have 25 minutes.
Excellent. Thank you very much to the organizers for including this paper on the program. That's a joint work with Mariassunta, Giannetti, Martina, Jasova, and Caterina Mendicino. Caterina is here. She's at the ECB, so the usual disclaimer applies. This is a paper about security losses, interbank markets, and how they all fit together in the monetary policy transmission to the final product, which is the credit supply to the real economy. And the motivation for this paper comes really from, back in 2023, we had a bit of a banking turmoil or banking drama, and the collapse of the Silicon Valley Bank highlighted how securities losses on banks' portfolios of securities triggered by the hike by the Fed can affect financial stability and lead to bank runs or even insolvencies. However, security losses are often overlooked if banks are well capitalized or they do not directly affect the regulatory capital. And in this paper, we argued that security losses can actually reduce the credit supply to the real economy, even in well-capitalized banking system, and even if they don't directly affect bank capital. And the mechanism you have in mind is the bank-based collateral channel of monetary policy. Sort of the starting point for this mechanism is that banks face inherent liquidity risks due to the maturity and liquidity mismatch of their assets and liabilities. And to manage the negative liquidity shocks, banks use actively their securities as collateral to pledge in the interbank markets or with the central bank to tap liquidity and counteract these shocks. And if the value of the security holdings falls, for example, due to the monetary policy tightening and the prices of the securities falls, this effectively lowers banks' borrowing capacity and limits their ability to insure liquidity risk. And for precautionary motive and to limit the exposure to future liquidity shocks, banks may reduce their willingness to provide very liquid loans to the private sector. So despite the potential importance of this channel in the transmission of monetary policy, the empirical evidence remains limited. And so that's where our paper fits in. We try to fill the gap and ask, what is the effect of monetary policy on bank lending through this collateral channel? And so to answer this question, we are going to zoom into the recent tightening cycle by the European Central Bank that started in July 2022 when ECB hiked rates for the first time in over a decade to fight the rising inflation. And this hike in the rates triggered a decline in prices, especially for long-term securities. And as banks in the euro area, but also in many other countries, hold a large fraction of their assets in these long-term securities, this triggered a large heterogeneity in security losses that banks experience. And in order to answer this question, we are going to leverage a micro-level data from the euro area on sort of the three pieces that are essential to answer these questions. First, we observe the bank ISIN level security holdings information, including the holdings, but also the prices that allow us to compute the amount of the security losses at the most granular level. Then we are going to use it to study the impact on the interbank lending and borrowing, both the secured and unsecured markets at the loan level. And finally, we will leverage the loan level firm credit registry data to study the propagation to the real economy. So before delving into the paper, let me give you a quick summary of the main findings. So the main sort of contribution of the paper is the documentation of this bank-based collateral channel of monetary policy. And this collateral channel, sort of the findings can be structured around three main lines. The first thing we look at is the interbank market, and we find that banks that experience security losses in the collateral that can be pledged in the interbank markets are experiencing a constrained amount of borrowing that they can receive in the interbank markets. Right? The falling value of the collateral makes them being able to tap less liquidity. And consistent with the collateral channel, we find that this effect is stronger for banks that are especially close to the collateral constraint, which is measured using the collateral utilization rate. And obviously, there may be other channels going on, for example, the net worth channel or the creditworthiness channel, but we do not find much evidence in support of it. So specifically, we do not find evidence of security losses having impact on unsecured borrowing that should be specifically, strongly driven by the creditworthiness. We also do not find evidence on differential impact across banks' capitalization rates. And we also differentiate across two types of securities that banks hold: those that are available for sale, those that the losses feed into banks' capital, as well as those that are held to maturity, so they don't affect banks' capitalization. And we don't find any differential effect of losses across these two groups in the access to the interbank market. Second, we examine deeper how banks manage this decline in the access to liquidity market through their intra-group borrowing and lending. So many banks belong to the banking groups, and we find evidence overall of liquidity redistribution through the internal capital markets of the banking groups. However, there is an important segmentation there that we document. Specifically, we show that domestic subsidiaries of the banking group, so those that are headquartered in the country of the head, are able to substitute the decline in the access to the interbank market with the intra-group borrowing. However, this is not the case for the foreign subsidiaries, who are not shielded from this shock and face tighter constraint. So we find evidence that this segmentation happens along the national lines. Finally, we study the propagation to the real economy and look at the impact of losses on lending to firms. And we find that banks experiencing larger security losses that cannot, that face decline in their borrowing capacity also decline corporate lending, in line with sort of this idea that the banks use interbank markets as a way to manage liquidity risk. And consistent with the supply effects, we show that the banks not only decline the quantity of loans, but also charge higher rates and shorten the maturity of these loans. And finally, we show that the domestic subsidiaries, because of this access to the intra-group borrowing and internal capital markets, are partially shielded from the shock, while the foreign subsidiaries and standalone banks are much more exposed. So this points to an incomplete banking union where these internal capital markets cannot really serve as a way for banks to share this liquidity risk. And these internal capital markets do not overcome national segmentations where local liquidity pools and deposit insurance firewalls at the national level fragment the transmission of monetary policy to the real economy. So let me skip the literature and dive directly in the paper. So a few words on how we compute security losses. So we leverage this granular data on banks' ISIN level security holdings. And we measure the losses at the bank time level as a cumulative change in the value of security, cumulative vis-a-vis the Q1 of 2022, so prior to the tightening. And in order to overcome potential confounding impact from banks reshuffling the portfolio, we're going to keep the portfolio holdings of banks fixed at the pre-tightening period. We will normalize the losses as a share of banks' total assets. And we will construct the losses separately for different types of securities. For example, the held to maturity and available for sale we observe which ones are which, so it will allow us to construct these losses separately for these two groups. So this is the evolution of securities losses over time. So at the end of our sample, they are on average about 0.5% of total assets or 10% of equity. And most of the losses were realized in Q2 of 2022 in anticipation of the rate hike, and right after the rate hike in Q3 of 2022. Now, importantly, there might have been other shocks going on related to, let's say, lack of fiscal consolidation after the COVID, which might have been driving the prices of long-term sovereign bonds, which are the big chunk of securities banks hold. So in order to account for that, we are going to absorb this potential impact of political or country risk effects by including in the model, in the regression, the country time fixed effects. So in the first part of the paper, we look at the impact of security losses on interbank borrowing. And in the first column here, this is kind of the main result of the paper. We find that the banks, after the monetary policy tightening, experience a decline in the value of the securities they hold, and they are able to access the interbank markets less. Their borrowing capacity is falling. And it's quite economically significant. One standard deviation increase in security losses is associated with about 3.8% decline in the credit that they can receive in the interbank markets. Now, we find a lot of evidence in line with the collateral channel. So specifically, first, we can differentiate securities between two groups, the ones that can be used as collateral in the interbank markets and the ones that are not accepted. And we find that the decline in the value of only the pledgeable securities, so those that can be accepted as collateral, leads to a reduction in banks' ability to borrow in the interbank market. We do not observe a similar effect for the non-pledgeable securities. Second, we also differentiate banks in how constrained they are in terms of their collateral utilization rate. So some banks may have used a lot of their collateral prior to the tightening to borrow either from the ECB or the interbank markets. And those are the banks with high utilization rate, with being closer to the collateral constraints. And those are the banks that experience a larger drop in the interbank borrowing. So what I showed you in the table, we can also present graphically in the form of dynamic effects in the diff setup, where we look at the impact of these exposed security losses across banks over time. And consistent with the parallel trends, we find that there is no differential impact of those exposed losses and banks' exposure to them prior to the policy tightening. Only after ECB started the hike and banks started to accumulate larger and larger losses, we see them leading to a decline in the amount that banks are able to borrow in the interbank market. The next step in sort of the support and corroboration of the collateral channel is splitting the interbank borrowing between the repo, so the collateralized one, and the unsecured, the non-repo borrowing. And the security losses appear to have only the negative effects on the ability of banks to borrow in the market that they actually matter. So in the repo market, while they don't have any effect on the unsecured market. Next, we also differentiate banks with respect to their capital position prior to the monetary policy hike. And we do not find any evidence that there is any differential effect, suggesting that alternative channels such as the net worth channel is not really what's driving the effects. In line with this, we also split the securities between AFS and HTM, and we find that the effect on interbank borrowing is very similar. So how did banks react to this decline in the ability to tap liquidity in the interbank market, where many of them are part of the large banking group, so they can use intra-group borrowing to substitute the decline in the in this sort of interbank market. So the first thing we look at is splitting the interbank borrowing into the ones that is coming from banks that are outside of the banking group and then within the banking group. And we find that this decline in the interbank borrowing is entirely driven by borrowing from banks outside of the banking groups. Now, if we zoom into within groups, it has opposite effects. It has banks are able to substitute with just tapping the internal capital markets. And it's quite sizable, but it doesn't offset the overall decline in interbank borrowing. Now we are further splitting the banks into foreign and domestic subsidiaries of the banking groups. And we find that only the domestic subsidiaries, those that are operating in the country of the headquarters of the banking group, receive more intra-group credit in response to security losses, while the foreign banks are actually not shielded. And how does it work? If we further split the lending bank between domestic and foreign, we see that foreign banks do receive some liquidity from other foreign banks, but that's not large enough to shield them, while the domestic banks are borrowing from other domestic banks within the banking group. So there is some liquidity insurance. So overall, these internal capital markets exhibit very strong border effects due to the national deposit insurance and local liquidity pools. So in the final step of the paper, we are zooming into how these security losses further propagate into banks' corporate lending. And so we will be using for that purpose the loan level unaccredited data where we observe bank firm borrower lender relationships, and we examine the impact of bank level security losses on the amounts that banks are willing to supply to the real sector. And importantly, we will be controlling for the credit demand with firm time fixed effects. And so what we see in the first three columns is that these losses that banks accumulate that constrain their access to the interbank market propagate to the real sector. We see that banks experiencing larger losses also lend less to the private sector compared to other banks. And the magnitudes are quite large and economically significant. One standard deviation increase in bank losses is associated with about 5.5% decline in lending to firms. Next, we are further differentiating between the type of securities that banks, on which banks are experiencing the losses, so between HTM and AFS securities. What we find is that overall the lending declines are primarily driven by the losses in securities that are accounted at historical cost. So those are the held to maturity securities that do not impact banks' capital position. Now, for the AFS securities, the effect is still negative, but it very much depends on banks' capital position, because those are the losses that banks need to internalize in terms of their capital. And they are larger for banks, the negative effects on corporate lending are larger for banks that ex ante had lower capital position. And finally, we provide an additional evidence that it is indeed the collateral channel driving the effects within the firm lending outcomes. So for that purpose, we add additional interactions of losses with three proxies for the collateral channel. The first one is the collateral utilization rate. So that's the one where we show that banks that are closer to the constraint, that they have higher utilization rate, also experience a larger decline in interbank borrowing. And those are banks also that extend less illiquid loans to firms after they realize those losses. Further, we look into the bank's differential exposure through their ex-ante excess liquidity. So those are the amount of reserves that they had ex-ante before the shock. And we find that banks with especially low excess liquidity before the tightening, those are the ones that have weaker liquidity buffers, and they reduce the credit by more. And finally, we also differentiate banks with respect to how stable is their funding overall. So this is a proxy for us to see how likely they are exposed to the large liquidity shocks. And we are going to measure it with the net stable funding ratio. In the final column, we find that banks with less stable funding, so lower NSFR, are the ones for which the effect is attenuated when liabilities are stable. So the ones with more stable funding are gonna cut the lending to the real economy by less. All right, finally, we are also zooming into the differential effect on credit to firms between banks depending on whether they are standalone or they are part of the banking group. And we find that standalone banks contract their lending by a lot more. So those are the banks that cannot tap internal capital markets in order to counteract this decline in the ability to borrow in the interbank markets. And then we further split the banks that are part of the banking group into foreign and domestic. And we find that foreign subsidiaries are especially more likely to contract credit by more than the domestic ones. Again, because they are operating outside of the country of the headquarters, so they are less likely to be able to tap these internal capital markets, which is again consistent with sort of this reallocation of liquidity along within the banking groups and the constraint at the national borderlines. All right, so to conclude, in this paper we document a collateral channel in the bank-based transmission of monetary policy. We show that the monetary tightening is reducing the value of securities that banks use as a collateral to access interbank markets and limit the ability that they can borrow in these markets, which further propagates into firm credit that banks are willing to supply. And importantly, we find that these differences in the banking structure between standalone banks as well as domestic and foreign subsidiaries of the banking groups may actually mitigate in the case of the domestic, but may amplify in case of standalone and foreign banks, the asymmetry in the transmission of monetary policy. And that can kind of happen at the national borderlines where banks operate in the local liquidity pools and national deposit insurance, which can segment the transmission of monetary policy along the country lines. Thank you so much, and I look forward to Jenny's discussion.
So Jenny, you have 15 minutes.
Well, good morning, everyone. Thank you for having me. It's great to be here facing this audience to talk about monetary policy, banks, liquidity, and repo collateral. I know this is going to be your favorite lunch topic. Let me start simple. Okay. So when the inflation rises up, the central banks, they try to curtail inflation. They will increase the policy rate. Okay, this is quite straightforward. What is less obvious is what happens next. How these hike rates will travel quietly through the bank's balance sheet. And this paper looking at the angle from the securities held on the bank's balance sheet. So when the rate is increasing, the fixed income securities price goes down. This is the US Treasuries index. You can see it goes down. And with that happening, both the securities available for sale or held to maturity, they're going to have the unrealized losses on the balance sheet. Okay, and the US providing us a vivid example is Silicon Valley Bank. So during the dynamic, SVB was swimming in the deposit, mainly from the tech firms. And they invest largely of their deposit into the safe long-term treasuries. And then everything, as you know, inflation spiked, Fed tried to raise the interest rate. And SVB has $91 billion bond portfolio had fallen to $76 billion with $15 unrealized losses. So when SVB tried to sell some of the bonds to meet the withdrawal, it revealed such losses. And those uninsured depositors see those losses, they run. And they run faster than a Bloomberg alert. Boom. And that is the first Twitter-fueled bank run, a very classic case. So this paper, the authors try to ask, that is there such a similar channels in the Euro areas? So specifically, they ask whether the interest rate monetary policy tightening, they will causing this valuation loss of security, and whether this valuation loss of securities will reduce their collaterals and further strain the bank's liquidity. And with bank liquidity, they're going to affect the bank lendings. Okay, so we all agree that at the beginning of the point, that interest rate increase will reduce the security values. We also all agree on the ending point. With bank liquidity stress, they will curb their lendings. So the point is in the middle point, these collateral channels. And that is today what my comments mainly it is. This question is important. It perfectly sits between the monetary policy and the market plumbings. So I will make some suggestions for this middle part of this collateral channel, and this is what I believe the authors can tightening the boat a bit. Okay, so let's go to the first order issues. When the monetary policy increases, they're making the yields on the fixed income securities rise too, and their prices fall, okay? And in terms of the accounting, the market value of available for sale securities will decline. But this decline, because it's only showing on the book, it's not showing on their P&L profit and losses, but it will reduce the total equity of the banks. So that's the capital side. For the holding to maturity security is different because they are using the book values. So they will have unrealized losses unless the banks sell it. This has zero impact on the net income and zero impact on the bank's equity. The most important thing is a valuation loss is not automatically a liquidity problem. You know, as central banks, monetary policy tightening, monetary policy expansion, that's a normal exercise. It happens many times. Indeed, historically, the valuation losses have very limited impact on the system-wide liquidities, okay? And then why it does not, we have not observed those things historically. Well, very importantly is this impact depending on the bank's total banking liquidities. Where is their reserve buffers? Where is their alternative funding sources? And this is also related to the overall funding environment. So that is the first important thing you need to keep in mind. Valuation loss is not equal to a liquidity problem. Next, let's see, is the valuation loss big enough to matter? So if you're looking at this figure, 3B and 6B, the left is showing the holding to maturity available for sale security losses. It's less than 1% of the total asset. If you're looking at the right panel, at the country level weighted average, all the 7 countries in the sample, all of them is less than 1% of the total asset. To give you a benchmark, according to the European banking authorities, in those 2 years of the sample period, the European banks' high-quality liquid asset is about 21 to 22% of the total asset. So far, no fire alarm, right? But as the plumbing, as if you do the plumbing, you know it, small cracks can matter in the plumbings. So the key is the micro heterogeneity might be matters. And the paper is actually show even modest this valuation shift can actually affecting the collateral value. This is a neat contribution of these papers. Now, when we're going on, we need to check what is the specialness of this European interbank market. You know, this morning you have heard a lot from Syria about the US interbank market. The two cross-Atlantic are not the same. That is when I reading the paper, my first response. Because this paper is showing security valuation loss reduce their collateral value is because of the banks can borrowing less from this interbank market. And because of that, their banking liquidity will reduce. The point is, interbank market in US and in Europe are different. In the United States, like the Shreel's paper, when we talk about interbank market, we actually refer to the short-term lending and borrowing between banks to manage the reserve balance at the Fed. So this is unsecured short-term fundings. The interbank potentially, theoretically, can also do through the secured short-term funding in the repo market. But as my paper with Sebastian also showing, the banks do not lend directly each other in the repo market. If they do, it's only lending to their affiliated broker-dealers, not to this interbank transaction. So this is what we mean, the interbank in the US. Now, we need to see the distinguishment of the euro areas. Let me borrow a slide from Mrs. Schnabel's earlier talks. Okay, so she's showing, this chart is showing the European banking interbank market. The yellow is showing the secured interbank lending, and the blue is unsecured. So takeaway point is very simple. In Europe, it's predominantly by this secured repo transactions. So that is making this paper that's more important. You need to distinguish why this interbank market matters, because Europe is different. In Europe, it does affect collateral, but in the US, it plays a very limited roles. Okay, so what did this paper do? They try to check whether the security losses will cut the interbank borrowings. And they're using this setup of the regression. I will address it in 1 second. And they pretty much to show banks with larger collateral losses, they will borrow less in the interbank market, not distinguish between the AFS and the HTM. Okay, so let's, it's a good test, but I will suggest a few ways to make this paper sharper. So if you're looking at this identification specifically, they are using 3 types of fixed effect: borrower-lender fixed effect, country level, the borrowing bank and the lending bank's country level time varying fixed effect. First, if you are using the lender-borrower fixed effect, your result is pretty much reflected within pair variation. So within each borrower-lender pair, this average, this borrowing is reducing. But this is not necessarily bilateral transaction, not necessarily reflect the bank's overall borrowings. So the key is overall borrowing matters more. It's total liquidity. It's not bilateral matters. And the controlling for borrowing bank and lending banks country by time fixed effect. This is not sufficient. We all know banks' liquidity, banks' credit condition, they play a big role to their lending, even in the interbank market. So we need to include in this bank time fixed effect, or at least controlling for the bank levels liquidity and credit condition. More importantly, this data is at the loan levels. For each of this loan, and your topic is collateral. You know, we study their loan amount, but loan price can affect loan amount, loan maturity, and loan collateral type. All of those loan level characteristics can affect the loan amount. So we also need to controlling for those characteristics to tightening these regressions. And ultimately, it's not the interbank that kind of borrowing matters. In order to affect the bank's lending, it's the bank's total liquidity matters. So my suggestion is, first, in the interbank market, instead of looking at what is the bank's borrow, looking at their net borrowing. Because banks both borrow and lend in the interbank market, and it's pretty much in the equal kind of magnitude. So the net matters. Outside the interbank market, you should examine the substitution across different funding sources. from today's Mrs. Schnabel's talk, we also see there's a lot of these refinancing facilities. Banks heavily use it. What is their access to central bank facility? What is their access to wholesale deposit and intermarket? Those things matters. Like my paper with Arvind Krishnamurthy showing, if you want to understand a bank's liquidity, you need to look at both the asset side market liquidity and the liability side funding liquidity. All of them matters for this liquidity. If you have less interbank borrowing, this might not necessarily mean the less liquidity, because if the liquidity is offset somewhere else. And also, we need to consider the context. This is again borrowed from Mr. Schnabel's one of the keynote speech 2 years ago. So, and this Jonas also mentioned in his second paper this morning, there is a significantly Fed unconventional monetary policy, for example, the PEPP, APP, and things. So beyond those policy rate increase, you also observe this shade blue area, that is excess reserve. So we are in the ample reserve period. Banks have tons of liquidity sitting on their balance sheet. And if this is a country level information. So with such record high excess liquidity, interbank funding still matters. If you can get access from the central bank and alternative, and controlling for the bank level reserve ECB facility, it actually matters to tell the audience whether it's uniquely this interbank market or it should go beyond this aggregate liquidity market. Lastly, this paper shows something very interesting within this intra-group liquidity transfers. And the paper's finding is that banking groups reallocate liquidity towards subsidiaries with losses, substituting for the interbank borrowing. But this is only works for the domestic subsidies. Okay, so let's think about some simple examples. Suppose I don't know how to pronounce its name, Unit Credit Bank AG, that is a German bank, but it's under the Italian parent. So they have a bank subsidiary in both Munich and Hamburg. Why do they have significant different security losses large enough for one to transfer liquidity to the other? You can imagine they all under similar guidelines by their parent, but why there is significantly internally heterogeneity? Who coordinates such internal transfer? Is that its headquarter companies or the branches? And what are incentives and terms to govern these internal loans? Those are all the important questions. And also, this bank has foreign siblings all under the Italian parent. So why do their Italian siblings want to transfer liquidity or the vice versa? Is there any frictions for this internal transfer? This is a super interesting word, but I think a little bit more institutional color can make this story much richer. So in the end, I think this paper tackles very timely and critical questions. That is how valuation losses on securities, they do affect monetary policy, not through threatening the solvency, but rather tightening the liquidity. But the authors can use their regulatory data in the granular data to tightening some of these bolts to make the analysis sharper. But I think this paper can make more contribution to understanding bigger questions. As I said, historically, valuation loss have very limited impact on the system-wide liquidities. The key is to understand under what conditions monetary policy tightening might trigger liquidity pressure, when and how and whom. As we have learned again and again, valuation losses rarely matters until the moment they do. Thank you very much.
Thank you, we're right on time. So let's take questions from the floor. Yep.
Thank you very much. Very quick one. I did not see, or maybe I missed it, any remark regarding hedging practices applied in banks, especially when dealing with valuations. And given your example related to SVB, which has been documented for not having very strong hedging practices, I wonder if that should be part of the analysis as well. Thank you.
Yeah, so that's an important question. Thanks for that. So hedging is going to be very relevant when you have available for sale securities. So those are the ones that you need to account for in your capital position, and that's going to mitigate the impact. For the securities that you pledge as collateral, hedging is not going to be that relevant because it's just the mechanical value of the collateral that matters for how much you are able to borrow. So for liquidity purposes, it's the actual value, with or without hedging, that matters here.
Okay, who's that lady over there?
Hi, thank you. Angela Maddaloni from the ECB. So I have one observation is, I mean, it links a bit to the discussion of Gianni. I mean, these valuation losses most likely have induced also some portfolio reallocation, I guess, and also possibly some reallocation in the collateral that is pledged also to the central bank. So I wonder if you have looked at this. And the second thing is an idea if you look, when you look at corporate lending, if you have looked at the sectoral implication, because I was thinking maybe basically banks finance only certain kind of loans, only to certain sector. I mean, a sort of marginal loans to specific industry that are financed through this channel, and this would sharpen a bit, you know, the identification of why you have this kind of effect.
Thanks so much. Thank you also, Jen, using this opportunity for the excellent discussion. So So actually, you know, what's surprising is that banks do not really sell those securities, neither ahead of time nor later. And the issue here is related to the regulation. So if you have held-to-maturity securities, which are the biggest chunk of banks' portfolios, you are effectively not allowed to sell them because they are held to maturity, right? So if for example, in the US, it would taint your entire portfolio, so you would need to account for market values of your entire securities book if you were to sell. In Europe, you need a special sort of approval for selling them, and it did not really happen. So even if we were to compute the losses accounting for some of the sales, which would be primarily the available for sale securities, the results are effectively unchanged because the available for sale securities are a smaller fraction and mostly short-term, so smaller losses that they account for. Now, in terms of the how banks use collateral, you know, between interbank market and sort of the central bank. I mean, what's interesting and what probably contributed to the fact that this had such strong implication is that ECB, at the same time as they started the rate hike, they also constrain the amount of liquidity that they provide to banks through the TLTRO. So banks had to, I mean, they effectively faced with higher costs of borrowing through TLTRO, they repaid it. So they had to shift some of their borrowing from the central bank into the private market, where haircuts are higher as well. And so that's kind of this sort of, you know, it kind of worked as a double-edged sword, that, you know, the hike coincided with the tapering of the liquidity. And we exploit in the paper some of that. We look at the sort of how banks were ex-ante reliant on central bank liquidity, and so those are the ones that especially had to shift to the private markets, and they are transmitting the liquidity shock through the decline in security values by more. Now, on the comment for the sectoral allocation of credit, I think what we do in the paper is that we try to isolate credit demand, because that's one of our worries, that, you know, banks may be exposed differentially to different firms or sectors in the credit that they provide. So we zoom in within a firm borrowing from two differently exposed banks to security losses, and that's kind of how we isolate the supply effects. But it would be definitely interesting to think how it might have shifted the supply across different sectors. We can look at that. Thank you.
Thank you. There was a question here.
Yeah, Francesco Papadia from the Bruegel Institute. Following up on this discussion about the connection between collateral for borrowing on the private market and collateral borrowing from the central bank, what can one extract from your evidence about a different issue, which is the possible easing or constraining of monetary policy that comes from changes to the collateral framework of the central bank. So how far can we be more specific on this issue, drawing from your evidence, just from saying, oh yes, if you loosen the collateral framework, it will ease monetary policy, if you tighten it will tighten monetary policy. Is there evidence that can make this statement more precise? Thank you.
Yeah, I think, so that's kind of related also to my earlier work, which, when you think about the policy of the central bank in providing liquidity, I mean, I think that the haircut policy is extremely important, and that's kind of like how ECB acted as the lender of last resort. Banks were able to tap their funding, and especially were able to pledge the collateral that was kind of high risk, but because of the more favorable haircuts that ECB provided compared to the private market. So I think it really matters how much value in terms of borrowing you can extract from a unit of collateral, and it's both the market value that matters, but also the haircuts. So I think there is obviously a complementarity there. Now, iterating sort of an earlier point, I think that the tightening of the liquidity provided by the ECB coinciding with the rate hike is something that, even though banks may have ample reserves, but sort of their ability to borrow against the collateral they had really shrank from both the central bank and from the private market, which why the propagation to the real economy was so strong.
Yeah, okay. Any other questions? Okay, go ahead.
Giuseppe Morafino, LMR. Thanks for the paper, very interesting analysis of this channel of monetary policy transmission, the collateral channel. My question is for the discussant, to be honest, in the sense that I want to understand why in your presentation you consider the ratio between HQLA and total assets. In reality, it should be HQLA versus expected net outflow for the liquidity cover ratio. Because in the context of sell-off on government bonds, my HQLA decline, LCR decline, ceteris paribus. As a bank, I want to increase the reserve share to be more protected in case of outflow. So this is an important channel, in my opinion, of propagation of collateral devaluation to lending volumes. And exacerbate, I would say, the tightening impact on policy rate tightening. Thank you.
I appreciate the question. I'm not studying the European market. I think that is important, as you mentioned. So I have very limited access. I tried my best to get the public data on the Europe. I'm much familiar with US market. So that's the only thing I got it is HQLA by the total asset. That's what I found. But your question actually inspired me to think if I do a study on the European market, it's crucial to looking at the component of each HQLA and their relationship. If I can have those access to the data, I think I probably can do much better job. But so far, all I have, I don't have the regulatory data. All I have is based on the public information, and they don't show such things. So that's a simple reason. Yeah. Thank you for your question.
US as well, but
US, I can do that. Yeah.
Okay. Maybe one more quick question, see if you have any. Okay, go ahead. Can you make the question very concise? Yeah.
So you talked about isolating the demand effect, but I think it also has to do with pricing, right? It could be that banks restricting loans because the securities lose value, but it could be also that they lose access to cheap funding and offer higher pricing for the firms which say no. How will you get this?
Yeah, so we looked at the loan rates, and that's, because the quantity is falling and the rate is increasing conditional on the same firm, we interpret it as the shift in the net supply of credit.
Okay, thank you very much, everyone. It's very nice presentation, nice discussion. and a lot of nice questions from the floor, which makes our discussion quite lively. And also there are a lot of issues that we have to think about going down the road. And if you have any further questions, maybe the authors and discussants were happy to discuss bilaterally during the break and lunch. So thank you very much with big hands to present.